they didn't fail to stop it at $65. Like they exposed the system because when a market tries to stay down and simply can't, you're no longer watching price discovery. You're watching control failure. Suppression only works when confidence is fragile. The moment price ignores pressure, the illusion cracks. And markets run on illusion far more than fundamentals. A price that refuses to stay suppressed is not bullish by default. It is diagnostic. It tells you where power is being exercised, where leverage is concentrated, and where fear is being mispriced. That's why $65 mattered. Not because it was technical resistance on a chart, but because it was a line of defense. Most participants stare at candles and indicators, waiting for confirmation. Professionals look at where pain is engineered. They understand that markets are not arenas of free exchange. They are battlegrounds of positioning. Every major level exists because someone has something to lose there. At $65, the objective wasn't to reject price permanently. It was to shape behavior, to send a message: momentum ends here. When institutions cap price, they're not betting against the asset. They're betting against belief. Belief fuels flows. Flows fuel instability. This is why calling it resistance is misleading. Resistance implies organic selling pressure. What happened at $65 was synthetic. Liquidity was layered. Shorts were reinforced. Options markets were skewed to dampen volatility. Algorithms were synchronized to absorb buying without allowing escape velocity. It was engineered calm, and it worked temporarily because markets are not linear systems. They store energy. Every time price was pushed down near $65, positioning became more crowded. Shorts grew complacent. Volatility sellers leaned harder. Range traders increased size. Confidence and control strengthened. That's how traps are built. Not by deception, but by consistency. Then price came back, not explosively, not emotionally, methodically. And when it crossed $67.3, the system didn't react because of fear. It reacted because the math changed. That level wasn't psychological, it was structural. Above it, exposure flipped from manageable to dangerous. Hedging models recalibrated. Risk desks ran new scenarios. Suddenly, holding the same position carried a different capital requirement. This is the part retail is never taught. Markets don't move because of news. They move because constraints are violated. News is narrative. Constraints are reality. At $65, large players were net short, not because they hated the asset, but because the trade paid to exist. Funding was favorable. Volatility compression generated yield. As long as price stayed boxed, time worked for them. This is how institutions make money, not by predicting direction, but by monetizing stability. Algorithms were tuned for range control. Mean reversion strategies dominated. Every spike was sold, every dip was bought, and liquidity was harvested from impatient participants chasing movement that never came. Confidence drained from the market while capital quietly accumulated in the background. The goal was simple: keep confidence low, delay FOMO, extend extraction, and it worked briefly. But stability is fragile when it's enforced. The more force required to maintain it, the more violent the release when it breaks. By the time price reclaimed ground above $67, the market wasn't underestimating upside, but it was overexposed to calm. That's when a number stops being a number and becomes a trigger. But $67.3 broke the math, not the charts, not the narrative, the math. The invisible layer beneath the market that determines who must act and who still has time. Below that level, risk could be managed. Above it, risk had to be resolved. And markets behave very differently when resolution replaces patience. Margin thresholds don't shift gradually, they grow, they jump. Risk models are built around discrete tolerances, not emotions. When price crosses a level like $67.3, collateral requirements change instantly. What was once an acceptable drawdown becomes a compliance issue. Phones don't ring because traders are scared. They ring because rules were breached. At that point, short sellers are no longer strategists. They become responders. Delta hedging accelerates because options exposure flips faster than human judgment can intervene. Market makers who are comfortably neutral suddenly find themselves short gamma. Every uptick forces buying. Every pause reduces liquidity. The very systems designed to stabilize price begin to amplify it. This is where speed is born. Leverage doesn't explode gradually, it snaps. And snapping happens most violently when positioning is stale. That's why Mondays matter more than people realize. Markets reopen not just with new information, but with reprocessed conviction. Over the weekend, risk committees meet, stress scenarios are rerun, geopolitical developments are contextualized, macro data is no longer by the time the opening bell rings, decisions have already been made. The open becomes a release valve. Orders stacked during closure hit a market that hasn't had time to breathe. Liquidity thins exactly when urgency peaks. Gaps form not because of surprise, but because everyone moves at once. This is where panic is misunderstood. Panic isn't emotional, it's mechanical. Banks rebalance risk not because they feel fear, but because their balance sheets demand symmetry. Funds neutralize exposure because correlation assumptions no longer hold. Value at risk models spike. Stress tests fail. Capital that was comfortable in one regime becomes illegal in another. Algorithms flip. The same code that suppressed movement now chases it. Suppression strategies shut off automatically when volatility thresholds are breached. Momentum strategies wake up. Trend following systems engage. What looked like disciplined control becomes sudden acceleration, not because sentiment changed, but because permissions changed. From the outside, it looks like chaos. From the inside, it's choreography. Every participant is executing survival logic at machine speed. There is no debate, no discretion, just response. This is why once these moves begin, they don't politely reverse. The system isn't asking where price should be, it's asking where risk can still exist. And this is where the story widens, because this move isn't about one asset. It never was. It's about global stress bleeding through price. Debt has reached levels where refinancing depends on perfect conditions. Liquidity is thinning as central banks quietly withdraw support while pretending normalization is harmless. Balance sheets are swollen, but flexibility is gone. Central banks are trapped, raise rates and fracture growth, ease policy and destroy credibility, intervene too visibly and invite speculation, do nothing and let pressure build. Every path carries cost, and markets feel that paralysis before headlines admit it. Capital senses hesitation faster than humans do. When confidence in policy control weakens, money doesn't wait for confirmation. It migrates toward scarcity, toward momentum, toward asymmetry, not because those assets are safe, but because they offer escape velocity from a system that can no longer guarantee stability. That's what 67.3 signaled, not opportunity, not euphoria, stress finding an outlet. Money doesn't flow to what is safe. It flows to what exposes the lie first. That sentence alone rewires how most people misunderstand markets. Safety is a story told after capital has already moved. In real time, money hunts contradiction. It hunts the place where official narratives break down, where policy intent collides with price reality, where control is claimed but no longer enforced, and $67.3 exposed it. Because the moment price overrules policy, the myth of managed markets collapses in real time. Central banks can guide expectations, regulators can shape frameworks, institutions can smooth volatility, but none of them can permanently override collective constraint failure. Price is the final court. When it disobeys, authority is questioned without a single word being spoken. This is the point where two very different forms of urgency collide. Retail panic is emotional, it's reactive, chaotic, driven by fear of missing out or fear of loss. Institutional urgency is colder, faster, and far more dangerous. It's not about belief, it's about mandate, risk limits, capital preservation, career survival. When those two forces meet at the same level, volatility doesn't rise, it detonates. That's why these moments feel surreal. One side is scrambling to understand what just happened. The other already knows and is acting on it. So what do you do now? You stop consuming markets like entertainment and start reading them like systems. Headlines are noise generators. They explain price after behavior has already shifted. Levels, on the other hand, reveal intent. They show you where participants are forced to change, not where they want to. You begin tracking prices that break behavior, not patterns that look good on a chart. You ask different questions. Where does leverage become illegal? Where do hedges fail? Where does calm stop paying? You reduce blind leverage because leverage is only powerful when time is on your side. And moments like this compress time. Fast markets punish overconfidence more brutally than wrong direction. Survival becomes a strategy. You position where asymmetry favors you, not certainty, not prediction, asymmetry, where downside is known, upside is nonlinear, and forced participants may have to buy regardless of valuation. This is how professionals think, not in outcomes, but in skewed probabilities. And most importantly, you internalize a truth that changes how you see wealth forever. Wealth isn't built by predicting prices, it's built by recognizing when the system loses control. Control loss is rare because systems are designed to hide it. When it appears, it doesn't announce itself. It leaks through numbers, levels, gaps, and speed. Those who understand it don't argue with the move. They align with the mechanics behind it because moments like this don't come often. Most of the time, markets oscillate, distract, exhaust, and extract. But when structure breaks, roles are reassigned instantly. Some people react, others reposition, and the difference between the two defines who looks back and says that's when everything changed. De-silence comes before acceleration, and most people mistake it for safety. Right now, the market feels oddly calm after violence, like a city just after an earthquake where the buildings are still standing, but the ground hasn't finished moving. This is the phase where damage is assessed quietly behind closed doors while the public debates narratives that no longer matter. Because once a level like $67.3 is breached, the market enters a post-control environment. In this environment, price is no longer optimized for efficiency, it's optimized for exposure cleanup. That distinction changes everything. Liquidity providers widen spreads not because volatility is high, but because trust is low. They don't know who is forced, who is hedged, and who is cornered, so they protect themselves first. This is where false signals multiply. Pullbacks look like reversals. Consolidations look like tops. Commentators declare cooling because the tape pauses, but pauses in post-control markets aren't relief. They're reloading sequences. Capital doesn't leave, it reorganizes. Behind the scenes, prime brokers are adjusting margin terms quietly. What was acceptable leverage last week becomes under review. Funding rates shift, haircuts increase, the cost of holding the same position changes without price moving at all. That's how pressure builds invisibly. Retail never sees this layer. They see green and red candles. Institutions see balance sheet friction. This is also where correlation begins to break. Assets that shouldn't move together start syncing up. Risk parity models wobble, diversification fails, not because assets are identical, but because liquidity is shared. When one corner of the market stresses, others respond preemptively. That's how localized moves turn systemic, and this is where the psychology of the crowd becomes dangerous. After a sharp move, people look for reassurance. Analysts provide it. Historical comparisons are drawn. This happened before. It's priced in. The markets always overreact, but markets don't overreact. They reprice regimes. A regime change doesn't announce itself with a crash. It announces itself when old rules stop working quietly, when dips don't behave the same, when suppression requires more effort, when confidence has to be defended instead of assumed. This is why volatility after control loss behaves differently. It's not symmetrical. Upside accelerates faster than downside because downside requires conviction, and conviction is scarce when exposure is fragile. Buying, in contrast, can be forced. Selling requires choice. That asymmetry is everything. It's also why narratives lag reality. Media explanations will rotate endlessly. Geopolitics, inflation prints, earnings, sentiment. None of them explain why the same type of news suddenly moves markets more than before. He said the answer is simple and uncomfortable. because the system's tolerance is lower. Tolerance is what disappears first. And once tolerance is gone, even small imbalances create outsized reactions. That's when overnight sessions matter more. That's when options expiries feel heavier. That's when minor data releases cause disproportionate movement. This is the phase where professionals stop being loud. They don't post, they don't predict publicly, they watch liquidity, speed, and response. They measure how fast the market heals after shocks. They test bids and see whether size is absorbed or rejected. They aren't trying to be right, like they're trying to see who is still trapped, because trapped positioning is future fuel, and fuel doesn't burn immediately. It waits for oxygen. What looks like boredom in this phase is actually compression of consequence. The market is deciding whether stress dissipates or escalates, whether this becomes an episode or a chapter. Most people won't realize which one it is until later, but price already knows. Decide today which side you're on. The most dangerous moment in any market is when everyone thinks the risk has already passed. That belief doesn't come from ignorance, it comes from conditioning. Decades of interventions have trained participants to expect rescue, stabilization, and narrative closure. Volatility spikes, authorities speak, markets calm, and the story ends. Except this time, the structure underneath didn't reset, it fractured. After a control level is violated, markets don't return to normal. They enter what professionals recognize as a reflexive loop. Price moves begin influencing positioning faster than positioning can influence price. Feedback replaces balance. This is where delayed reactions become lethal. Large funds don't reposition instantly. Their size prevents it. They scale, hedge, offset, and negotiate liquidity over time. That creates temporal imbalance, different players reacting on different clocks. Fast money adapts in minutes. Systematic funds adapt in days. Institutional reallocations unfold over weeks. Price becomes the messenger between them. Each move higher forces another layer of adjustment, not because fundamentals changed, but because exposure did. A rally doesn't need new buyers when existing participants are already misaligned. It only needs friction. This is why drawdowns suddenly feel shallow. Selling pressure exists, but it lacks follow through. Every dip finds reluctant sellers and urgent buyers, not optimistic buyers, obligated ones. The tape starts behaving strangely. Strength on bad news, resilience during macro uncertainty, acceleration without volume explanations that make sense to the public. This is not strength, it's imbalance expressing itself. The crowd misreads this phase as confirmation that the worst is over. Commentators call it stabilization. Risk models extrapolate recent calm forward, but calm after stress is often not recovery, it's deferred resolution. Under the surface, cross collateral stress builds. Losses in one area are masked by gains in another. Balance sheets appear stable while internal correlations tighten. When those correlations converge, diversification collapses instantly. That's when unexpected volatility events occur. The irony is brutal. The longer the market holds together after control loss, the more violent the next adjustment tends to be. Time doesn't heal imbalance, it concentrates it. Positions age, leverage embeds deeper, confidence hardens. This is why professional desks monitor something the public never hears about: time at elevated levels. Not how high price goes, but how long it stays there. Duration increases sensitivity. The longer stress persists, the smaller the trigger needed to release it. And triggers rarely arrive as shocks, they arrive as inconveniences. A slightly worse auction, a mildly disappointing data print, a policy comment that removes optionality, something small but perfectly timed, enters a system already stretched, then speed returns, not gradually, abruptly. Liquidity thins first, then spreads widen, then price jumps between levels instead of trading through them. That's the moment where people realize the market they thought they understood has changed character. The professionals don't panic here either. They recognize the phase. They've seen it before in different forms, different assets, different decades. The pattern isn't about price direction, it's about loss of elasticity. Markets can bend only so much before they snap. And once elasticity is gone, precision matters more than conviction, because at this stage, being early feels wrong and being late is catastrophic. Most people won't notice the shift until after it's over, but the market has already moved on without them.